Did the market just bottom? I mean, it seemed that way this week until, of course, the big news came out where Moody's is the third credit rating agency that just downgraded the US debt from AAA rated to AA plus. So in this video, we're going to talk about some technical analysis and fundamental analysis. We'll see what the charts tell us, whether the market has bottomed or not, and what we can expect to see in the next week or two. I always start off my videos with one of my favorite indicators, AVWAP Q, which is VWAP, volume weighted average price, anchored to the beginning of each quarter. This indicator specifically works well on the stock indices like SPY, Triple Q, and the Dow Jones Index. On my screen, I have SPY, and I always start off my videos analyzing SPY because SPY is a market, the S&P 500. So whatever that index does, most stocks will follow. Um, so yeah, let's start. So VWAP, this white line plotted here, very easy to read. When price is trading below it, it signals a short-term bearish bias. Sellers are in control. You should focus your trading on the short side because that's where the demand is. And then when price trades above VWAP Q, AVWAP Q, that signals a short-term bullish bias. Buyers in control. Focus your trades on the long side. That's where the control is. And as you can see, basically since this huge historic candle we had on the market on April 9th, price has mostly been trading above AVWAP Q with exception of this one down day on Monday, April 21st, which was recovered the following next day and hasn't looked back since. So if you saw this, you would start closing out any bearish trades you'd have, right, during this time here, and start looking for bullish trading opportunities. And if you did that, you would have been successful. On after hours and on my Discord, every day I post a little snippet of like a really brief market analysis post, and where I show all these indicators and tell you what bias you should have for your trading. So if you're interested, the link will be in the description below. It's free, so you have nothing to lose. So price is still way above AVWAP Q, therefore I still expect to have a bullish bias in the short term. Now, the market dropped basically 20% from all-time highs, even 21.4%. But from close to close, the market has dropped just under 18%. So never officially entered a bear market, which is defined as prices closing, from close to close, from peak to trough 20% or more. So that hasn't happened. And one thing I was really watching on a technical level was this breakout of the swing high in this downtrend. So a downtrend, which I did make a video about this actually last week, a really short, brief video explaining this technical, I guess, analysis you could say of trend reversals. And just to briefly go over it again, a downtrend is when the stock is making lower highs and lower lows, just like that. And an uptrend is the opposite, when the stock is making higher highs and higher lows. Now we see this downtrend reverse into an uptrend. Well, what gives us this reversal signal? How can we see this pattern forming a little bit ahead of time so we can position ourselves early in this move up? Well, when price breaks above this most recent lower high in that downtrend, right, and holds it for 5 consecutive days or more, that tends to signal that the trend has reversed and prices should continue to move higher. And I'll show you examples of this. In 2022, the bear market of 2022, right? Before we look at all this price action here, this is what we saw. We saw a drop from all-time highs of up to 14.5%, so similar to what we saw this year. And we saw this market rally super strong all the way past even the swing high here, right? As you can see, we have a wave down, wave up, wave down. That's the downtrend. Lower highs, lower lows. And we went all the way up here. Let me move this out the way. And it's like, whoa, this might be a trend reversal. And the thing with technical analysis to keep in mind is that nothing's ever guaranteed. Everything is about odds. And when something in your analysis on the charts tell you that something might happen, all it's saying to you is that the odds of it happening have increased, not that it's guaranteed. So generally, statistically, when prices stay above a broken level or below a broken level for 5 consecutive trading days, that's a very strong signal that the chances of that move sustaining is much higher than it would have been. So if we look here, we see that price only closed above that level for 2 trading days, where it fell below and made a huge leg down in the market and continued this bear market that we had in 2022. I'll go for another example. Let's go over here. This was in 2020, September, as you can see. And this isn't a big drop, right? Compared to what we just saw. This is a 10% drop. But, same idea. Wave down, wave up, wave down. All right. We broke above that swing resistance for how many days? 1, 2, 3, 4, 5. 5 days in a row. Wow. Well, like I mentioned to you earlier, nothing's ever perfect, just increases the odds. In this case, we never made a lower low. So while the trend did reverse, not only did we not make a lower low, we made a slightly higher low too. So when you draw this out without these candles, this is what you see. That's still a trend reversal, right? It's just analysis is a fickle thing in the markets. It's never perfect. It's never going to look like the schematic that you see drawn in all these lessons and stuff like that and diagrams. But you get the idea. It just gives you an idea of what you can expect. You can expect, well, all right, the price to close above here, and the odds of it holding here and continuing is higher, not guaranteed. Maybe you take some trades here and you put a stop loss below this candle, you get stopped out. Fine. The mindset's very important. Now you say, well, price might move lower. This is a good opportunity for me to add to any investments that I felt like I missed out on in this last dip here. So you buy some shares, and you see bam, 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 whoa, super bullish price action, we're closing above it. If you wanted to be extra conservative, even you can put another level here. You wait 1, 2, 1, 2, 3, 4, 5, go long, and there you go. You set yourself up for a really good trade on the long side. I'll give some more examples. COVID drop. Huge drop. We had one bounce pretty much in between that drop up here. We broke above it. 1, 2, 3, 4. Not 5 days in a row. Okay. Prices might move lower. They kind of did. Went back up, tested it. Went back up, tested it. Broke out again. 1, 2, 3, 4, 5. It held. Continuation up. I have more examples, but for the sake of time, you can go on your own and check out these events in history and see for yourself what this trend analysis looks like. Now this breakout was looking super strong this past week. I was posting and keeping track of if we're going to be able to close above this level for 5 days in a row, and we did. But not only did we did it on a really strong fashion. Let me put the volume on. Above average volume, heightened volume over here. Stacked, 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 stacked. Completely stacked green candles. Unfortunately, the news came out, right, that Moody's, which is one of the 3 largest credit rating agencies in the US, downgraded the US debt. So let me show what that looked like, what happened to SPY in the after hours, the market in the after hours. So as you can see, the market was down a whole percent after hours. Because that's when the credit rating downgrade news came out. Was it Friday after market close? Everything was red. The market was red, everything was down. And that news came out 2 other times in history. One in 2011 and one in 2023. So let's go see what happened in the markets during those headlines. So on August 2nd, 2023, Fitch Ratings downgraded the US credit, just like we saw yesterday. On Friday. So this is April 2nd, this vertical dash line, and we can see that the market ended up correcting 10%. Well, 10% total, but 8.5% from that date to the bottom. Now, this drop isn't all from that downgrade, but it certainly did not help things, especially it happened during the beginning of this downtrend, right? So this is where it happened, and at least from this point to where it bottomed intermediately, it dropped 4%. The other time this happened was from Standard & Poor's, S&P, and on August 5th, 2011. So I'll go back to 2011, August 5th, right over here. So clearly something else was going on before this this credit rating, but regardless, from this day, the day after that announcement, the market dropped almost 7% in one day. Granted, this was already near the bottom of this drop, which totaled, looks like about 17% from the top. But the credit rating downgrade did not help things. So based off these, it shows that market reacts negatively to this news. So the chances of Monday seeing a drop is pretty high, right? So what I expect to see next week is a pullback, which I'm honestly not surprised for, even without this headline, because the market has moved pretty much in a straight line since like end of April, right? From here, market's up 15%. And the market doesn't move up in a straight line. There's always pullbacks, and especially with big breakouts like this, there usually tends to be a test of that breakout or a gap fill, which is just below that breakout or something. If I post the moving averages on here, we have the 200 SMA basically lining up right, lining up right with this breakout level. On SPX is 577 or 5770. On SPY, it's about 576. So actually, now that I have these posted, you can see that there's a confluence of the 100 SMA, which is gray, the 200 SMA, which is pink, and this breakout level of 576. That's huge. So we have a confluence of three extremely strong support levels here, and I would definitely not be surprised to see prices on Monday fall right down to that level, at least 3% or so. I wouldn't be surprised to see that. What would surprise me is if we see like a super deep 4 to 6% drop down to the 50 SMA. That would surprise me, and that could invalidate the idea that this market has bottomed, because now we're back below this level. Again, it's no guarantees. TA, technical analysis, is an art, not a science. So we could see a scenario where the market drops, tests, drops, makes a second higher low, right? Second higher low here before resuming this uptrend and back to all-time highs, right? That could happen. Or we could just come down here, test it, hover around, consolidate, maybe go up. Or of course, like with anything's possible in the markets, we could just start continuing downwards. Maybe we get some bad news about the current trade deal, we get maybe Trump puts tariffs back on, cancel the 90-day pause, etc. Whatever, anything could happen, right? So be prepared for anything. That's why mindset is really, really, really important. So before you can trade, you need to make sure your mindset's set. What do I mean by mindset? For me, I have money for trading, and I have money for investing. Most of my money is used for investing. I want to make that very clear, because investing is where the money's at. Trading is a very difficult skill to master. It could be very profitable, very lucrative, but very few people do it consistently like that. And it's for a reason. It's a difficult skill to master, and it takes time. And every mistake costs you money. So, but investing, it can be as simple as buying the index. and you can pretty much assume you're going to get a 10% annual return. You know, like, so at the very least, you should have two accounts, one for investing, one for trading. And in my opinion, most of your money should be in investing. And how will that help with your mindset? Well, now you're not worried that the market's going to go down. Oh shit, if the market goes down, I'm gonna I'm gonna get stopped out of my trades. I had 5 call options on Nvidia, and now that's gonna be like lose all my gains I had this month. Versus if you're investing, you still have some cash left on the sideline. Like for me, for instance, I was buying these dips on the way down. I bought at the 100 SMA, I bought the 200 SMA. I definitely bought down here 15 to 20% drawdown, but I saved some cash because even though my studies showed that the chance of the market bottoming here was higher than 50%, I know that there's no guarantees. So I left 15% cash on the sidelines. And believe me, I have feelings too. I felt FOMO with this big, oh, I should have bought more Broadcom. Oh, I should have bought more Nvidia. I should have bought, but no, it's okay. You know, like you were saving cash in case the market pulls back. Well, if the market pulls back, wouldn't you be happy? I'm going to be happy. I'm like, okay, I have another chance to buy some Broadcom over here. I have another chance to buy some Old Dominion. I have another chance to buy some Salesforce. If the market goes down even lower, I'm really happy I saved that cash. I can start deploying it at even lower prices, which means that my forward outlook for my annual returns increases too. I can budget at home and make sure I'm saving money every month to invest in the market while the market's down, because that's where opportunities come, right? Warren Buffett, Peter Lynch, all those investors say the real opportunities are when the market enters a bear market. So definitely want to drill that into you guys. And now I'll briefly go over some fundamental analysis. It's always good to keep up with what's going on, any kind of economic news we could be expecting that can move the markets. And this past week we had an inflation report, which showed, again, another lower than expected reading, 2.3%, very, very close to the 2% target the Fed has been working on for a couple of years now. So remember, they have a dual mandate, which was to bring inflation down and to keep the labor market stable. And so far, that's what they've been doing. So props to them. Another measure of inflation was PPI. Came in way lower than expected, 0.5% down versus a forecasted uptick of 0.2%. Another constructive reading that supports the thesis and the expectation of 2 rate cuts this year, one in June or July and one in end of the year, maybe September or so. And let's see what we have next week. We have nothing next week. So what does that mean? That means that the only news we got was about Moody's, and that's going to have a negative sentiment in the market next week. So expect some bearish price action, I think, next week, unless Trump says something. That's the other thing that makes trading so difficult in this market. Trump as president means very volatile price action. He could tweet out something about a trade deal or about a threat or whatever, or negotiating tactic, and that could really move the market. So try to stay nimble and make sure that your trades are reflective of your confidence in the markets. If you're not sure what the market's going to do, you should be taking smaller position sizes in your trading. Focus on investing more, right? When you're very confident in the price action like we saw this past week, you can trade normally. So you want to be able to sleep at night, right? You want to be able to say that if I'm wrong about my trading thesis, I'm not going to be super sad and upset, right? You want to be prepared for the fact that you're wrong. When you're wrong, you don't want any emotion tied to it. You want to be, I'm wrong, cut my trade out for whatever loss it is, because I know how much that loss could be, because I took a smaller size expecting a smaller gain and smaller loss because I'm less confident in it. This is the mindset that you should be having. So I do want to end this video just with a little like a minute or so about my Discord, because I brought up like if you want to focus on investing, and a very common question is, what stocks should I be looking at? What's a good stock to buy? What price is good to buy? And That's where my valuation database comes in. I track about 35 stocks that I believe have excellent fundamentals that are worthy of your investment, that are weighted highly typically in the indexes, whether it's Dow Jones or Nasdaq or S&P or all three. And basically I'll show them here. You click on it and you'll see the stock's fair value, some fundamentals, an explanation of what each means, each of the ratios, a PEG ratio, ranking the S&P technical outlook, and some information about the company. This will save you a lot of time into knowing what stocks you should buy and at what price. If the market pulls back and you don't have Apple in your portfolio, or you do but you don't know when you should buy more, well, you can say, well, if Apple gets to 193 or below, I'll be interested in buying. Amazon. If Amazon gets to 211 or below, I'd be interested in buying because that would be the fair price of that business. So again, link in the description. I also do share all of my trades live right here, and I post a summary every week of my trading. And so this isn't to copy, right? Because I'm not a financial advisor, it's not financial advice and yada yada. This is for you to learn. You might see this trade, right? And just be like, hey, like, why did you sell a Google cash secured put at 140 with this expiration? Like, why? You can tag me in, our market discussion channel, and I'll answer you because I'm here to help, honestly. So on the video here, please check it out. If you found some value, I'd appreciate a like or a subscription, and I mean subscription to my YouTube channel. And good luck next week.